Right, okay. We've got the board here. And
Yes, Mark.
What's interesting about this board, I'll have to be honest with you. I've been following your little matrices for like, I don't know, a million years now. When it goes back to the 90s. But this one's quite a lot, okay? But for me, the top ones, the four horsemen are at the top.
Correct.
Probably not in order of importance, by the way.
At the top end of the things that are really important. The things lower down our board here are not unimportant, but they're
indicators.
They're not going to be the driver that forces the RBA to move. These top ones are the real punching ones. They're the ones that really, really impact the RBA.
And tell me, of the top four, could you just tell me one thing? How would you rearrange in order of importance?
Might do this next time we get together. I think inflation and labour market are the top two.
Good point. That's why I forgot about asking before. How come labour market has now become elevated? The Deputy Reserve Bank Governor we recently had an interview and he did talk about labour, the importance of unemployment. No, the importance of full employment, which no one knows what that means. So therefore we look at unemployment. But talk me through that because it's a new phenomenon.
A couple of things. One, as we've spoken about in the past, Treasurer Jim Chalmers had a review of the RBA.
Last year.
Implemented changes. They're still coming into being. They've got to pass Parliament, by the way. So that's why there's this delay, which is a little bit frustrating. But nonetheless, the changes there, and the critical one when Michelle Bullock was appointed governor back in September last year, was for her and the board, the Reserve Bank board, to give greater emphasis to unemployment when it came to setting full employment. Yes, correct. Sorry. When they consider interest rates. So yes, the 2 to 3% inflation target's still there. That's
primary.
That's primary. But if it's at 2.9 and unemployment's going up, even though it's not the middle of the target, they'd cut rates. Because look, we can tolerate an inflation rate at the upper end of the band. If unemployment's going up, we don't want that to happen. So the labour market indicators, so things like unemployment rate, job vacancies, wages, which is sort of part of the labour market, they're the critical things that the new deputy governor also mentioned when he gave that talk.
So would you say then, in terms of data analysis before each board meeting, that the unemployment number and also the seek job advertising and job vacancies, etc., and participation rates and underemployment numbers, underemployment numbers, I said that right? Underemployment numbers are going to become far more critical? The
short answer is yes, they are. They were always important, but I think they've even got an extra.
Are markets? I don't know if they wait. I don't know, but I'm just wondering: have markets reweighted their analysis?
No,
I don't see it.
I don't think they have because the labour market conditions right now are problematic.
I think they're average at best.
I think they're deteriorating.
They're average at best.
Mark, as you said, the SEEK job ads, the ABS, Bureau of Statistics job vacancies, they're all going down. Demand for labour is falling.
Underemployment is going up.
Underemployment and unemployment it's gone up 0.6 of a percentage point in a year. That's pretty chunky. In terms of people, that's about 100,000 people. Think about that. 100,000 people are unemployed today that weren't unemployed a year ago.
So if you and I are sitting here talking to Warren Hogan, who's very
hawkish.
Hawkish is the word. Would we be a bit more dovish and sort of say, hey, Warren, mate, the unemployment, have you taken this into account?
I've had this conversation with him, and Warren's got a lot of profile this last couple of months with his rate hike calls, and he's got I really enjoy reading it. I happen to disagree, sensible people can disagree on a topic, that's fine. But when he writes about it...
I asked him to come in with us, by the way. I asked him to come on, and he said, no, I'll come with you, Mark. I won't come with you and cook you together, because he thinks we're going to bash him up.
Come on, mate. I'm not going to bash you up, mate.
No, but he thinks we're going to join forces. But
anyway, we'll come next month because we'll still be having this debate, I know.
Yeah.
But the critical thing here is there's not a lot of discussion of unemployment, of the people who are, we've got to kill inflation, Fine. They in their articles they write, they very seldom mention the labour market, the unemployment rate, the wages side of the economy, which, as we've just discussed, is a higher importance,
much more weight
for the Reserve Bank than it was a couple of years ago.
Much more weight.
No question. Absolutely no question.
And I will just say one more thing, which is boring, but the non-accelerating inflation rate of unemployment, NIRU, she talked about 4.5. in July last year.
Yes.
She has not reviewed it. Has she reviewed it? I need to know.
There was the short answer is I think they have.
No, I haven't seen that published.
It
hasn't been published.
Last week, Michelle Bullock and one of the assistant governors, I was going to say Clark Kent, not Clark Kent, can't remember his first name, Mr. Kent, were appearing before the Senate. And one of the senators was asking, how's the economy? Nehru, I think they let slip it was 4.3.
No, hang on. They can't go and do this. They can't do a review of what they've already published without publishing it again. Surely.
They mentioned it in passing, and I was shocked that it didn't make headline news or that she wasn't followed up with more questions on the 4.3.
That's because no one understands this unemployment thing, mate. That's my point.
When they put out their forecasts in early May, they've got unemployment and coincidentally peaking at 4.3. They've revised that down from 4.5.
Well, then we should somehow press this. But if it's 4.3, we're very close.
We're very close. And in fact, we'll start on that if you want.
Yeah, let's start on it.
Because the unemployment rate's 4.1.
Yeah, I know. So I'm saying.
And the leading indicator. So 4.1, you might think, that's not bad. And it's not bad. Look, we remember 10% unemployment. That was absolutely horrible.
Well, during COVID, it got to 10.
We want full employment. I love Australia. I love our economy. I want it to be a good economy, not a basket case. So I'm going to put the labour market not quite fully in the easing category yet, but close to it. If we get another 2 months.
If 4.3 is right.
Yes.
Like if she could confirm that, somehow they could confirm 4.3 is the number that they think is inflation is not accelerating at.
Yes.
Or won't accelerate at. That's important.
And I think it's true too, by the way, because just by the way, even though unemployment's only at 4.1 and it's gone up, wages growth is already slowing. Inflation's already coming off the boil. So if you looked at what do we call empirical evidence, the data flow, unemployment's gone from 3.6 to 4.1. Wages have gone from 1.2 per quarter to 0.8. Sort of rattle all these numbers off. And the unemployment rate's gone up and it will keep going up. No question, it'll keep going up. So maybe the Nehru is 4. Could be. And that's
revised.
We'll find out in hindsight. It's one of those things you don't find out until you've done it, sort of thing. If that is the case, then it's all bets off for interest rates because they'll come down. As I said, I'm not going to put my hand on my heart and make that forecast now, but it is something I'm watching extremely closely.
I hope after the 18th, on the 8th, when she does that 1 hour
the press conference,
I really hope she addresses this.
I'll have a chat to a couple of my mates who go to those press conferences and say, just
press
ask
it.
about
press it a bit. Because
watch this space on the 18th.
Her paper was published in August last year.
Yes.
And it was 4.5.
Yeah, 4.5 was the number.
It's just modelling, but doesn't matter. It was published at 4.5.
But Mark, those models feed into their decisions on interest
rates.
That's my point. Affect you and me.
That's my point.
It might be a bit airy-fairy in terms of how they calculate it with all these economic models and regressions and all this other stuff. But if it does feed into the interest rate that you pay and I pay and everybody out there pays on their mortgage,
then we should know about it.
Loan, it matters. Yeah.
Right, let's go.
So I've got the labour market on that side. Similarly with wages, I've got them at neutral at the moment. So wages are sort of in the groove at around about 4%. On GDP growth, you'd cut interest rates. We've got a really weak economy. On inflation, I'm keeping that in the neutral to tighter because it's still 3.6. It's still away from the target. And this board, remember, is about actual data, not forecasts.
Yep.
It's what we actually know. So you can sort of see easing, slight tightening, slight easing, and neutral.
Brain damage.
That's why rates are on hold.
Brain damage. That's not talk. That's how I started off.
It is. So I haven't fixed your apologies, Mark. On the international, because don't forget, we're part of the global economy. I'm putting that erring on easing.
Yeah, but mate, you okay? Can I just say, our friends on the continent are all dropping rates. Well, not all, but America is not seeing it.
Well, America, look,
North America is not seeing it.
I'll start with my bias. Canada cutting rates, European Central Bank cutting rates, Sweden, Switzerland, okay?
The biggest economy in the world, but what are they doing?
US is on hold, but they've got this position where there's a presidential election in, 5 months, getting very close now, early November. Biden administration has been spending money like it's going out of fashion. They call it the Inflation Reduction Act or something, but their budget deficit is still 5% of GDP. Our budget deficit that came out the other day, we had 2 surpluses. Now we've got a deficit of 1% of GDP. And they've not had any surpluses. So if you look at the composition of their economy, government stimulus is unbelievable. So that's why the US Federal Reserve, when they look at their numbers, think, oh, we're going to have a slowdown, and it hasn't happened. One of the reasons is because government spending. And, maybe our budget should have been a bit tighter or whatever, but it was nowhere near. It was a million miles away from what the Americans are doing. But, you've got New Zealand about to cut interest rates too. Bank of England, okay, they've got an election too in a few weeks' time. Not that it affects the Bank of England, but inflation's falling in the UK. Unemployment's going up. The Bank of England's going to be cutting interest rates. So you've got this scenario.
ECB, what are the European?
European, they've cut 25. Yep. And Christine Lagarde, the governor of the European Central Bank, she sort of hasn't been committed to the next move. But,
but it's at least it's cut.
You don't have, it's very rare you just have one cut and nothing else. There's going to be another one sooner or later. So you've got Europeans cutting, Canadians, Kiwis about to cut. You got the English about to cut. America, certainly not hiking.
But it's been propped up.
Not hiking, but they've got a slightly different scenario. It'd be really rare for Australia not to be part of that. We're on the way up. The month and the magnitudes are all different. Of course they were. But it's the direction that matters. So, and the timing. When's our rate cut coming? But the international economy, and it is weaker. China, even though they don't have a financial markets like Aussie and American financial markets, they've actually been cutting interest rates too. Their economy's pretty poor.
Because that of course affects our GDP because that's 70% of our exports go there.
Correct. So we've got this, and if we looked at this, say 4 or 5 months ago, there are a few more of these beads over on this side, so they're moving that way. House prices, they're not going to cut. They're going up, and in fact, they've re-accelerated a bit. Mm. And if you look at Perth, Brisbane, Adelaide, my goodness, they're going gangbusters.
So how do how house prices, increasing house prices, affect, say, inflation?
Yeah, it's not necessarily, the RBA does not target house prices.
Or any asset class for that matter.
No, or stock market prices. Like that. They feed into, it's largely through a wealth effect.
Yeah.
So if you bought your house for, I'll use round numbers, for $1 million, goes up to 1.1, goes up to 1.2, goes up to 1.5.
You feel rich.
And your mortgage, just say it was 500,000 again, just using that, has come down to 400,000. All of a sudden, your equity in that house has gone up massively. You feel rich. You can approach your friendly mortgage provider and say, mate, I'd like, that kitchen's a bit crappy. I need to sort of renovate the kitchen, the bathroom. Yeah, here's another $100,000 on your mortgage. And the lender would be very happy to do it.
It's potentially inflationary.
And so that feeds into spending. So high house prices in and of themselves are not the reason they hike. If it's sustained for any period of time and we all feel wealthy, or homeowners feel wealthy, I should qualify that very dramatically, then it does actually have a positive effect. And the Reserve Bank has actually done some fantastic research on this, which I've spent too much time reading. But when house prices go up 10% and stay there, so the 10% shift up in house prices, with a 1-year lag, because it takes people a little while to realise my house has gone up in value, it increases household spending over and above what it would normally be by 0.7%. Now, that might not sound a whole lot, but if household spending is 3% a year and it goes up by 3.7, that is
it's double.
Big bickies. It's big bucks. Yeah. So that's how it matters. Retail sales. Oh, dear. If we
that's off the board.
That's even off the board. Speaking to any retailers, Mark, I've had a few, what do we call it? Frank discussions with a few mates in retailing. Shocking. Worst in a long time. Consumer sentiment, same thing. We consumers were feeling glum. Cost of living, interest rates, rent. God, it's pretty crook. Building approvals. I wish the government luck building 1.2 million houses over the next 5 years because they're currently running, because that's an annual rate of 240,000 per year, they're currently running at about 160. So they're running a third, 35% less than they need
That
to.
has a converse effect to both.
That's negative for GDP because if you're a builder or a supplier of materials, timber, windows, wire, and you're working in the building industry, business is drying up rapidly.
That has a slightly converse effect too, around the other way, because it can mean that there's not enough housing for the number of people.
It feeds back into house prices.
Goes back to rents.
Shortage of housing, correct. And that's why there's such a debate and a dilemma about what on earth do we do to get the number of houses up, the supply of housing. Business investment. it's okay. As we were saying before, businesses are starting to ramp up a bit of CapEx. We're building warehouses, machinery and equipment, AI. I don't fully understand artificial intelligence, but people are spending a lot of money on it. That's good because it employs people and it's part of the economy.
Well,
That's actually doing okay. It's doing well.
And we get business investment, business confidence.
Business confidence is a bit weaker. We just had numbers out that were a little bit weaker. So businesses are doing okay. Oh, look, I put it in the middle. Businesses are okay.
Yeah, we've got, one of the things about business confidence and business investment where it's important is that a large degree of reinvesting in your business has been around me getting greater productivity.
Yes.
Because my inputs and costs have gone up and I need to get more product out in order to make the same amount of money I was making before.
Correct.
And so artificial intelligence, for example, is a way that I might be able to sack a few people.
Indeed. You can get a machine to do stuff. You have 2 or 3 people running the machines instead of 10 people doing the work sort of thing. Again, one of my favourite ones I like to use, and remember the Harbour Bridge, driving over there, 20 cents, and they'd have the poor person putting their hand out, 20 cents, 50 cents, whatever it went up to. Yeah, that employed a lot of people. 24 hours a day, 7 days a week, and then someone had to count the bloody coins and all this.
Well, then you
stuff.
had to collect it.
Collect it, count it, all that other stuff. Now, with the beep, how efficient... There'd be someone who made the beeping machine, the tag, but how efficient's that? So that's more output, and there's more cars go across the bridge today than they did 20 years ago through the tunnel. How efficient's that? That's more output for fewer workers.
Fewer jobs.
Good for productivity. Commodity cycle, neutral. It had a bit of a blip up. It's gone a bit back down. Copper and oil went up a bit because of Middle East conflict and artificial intelligence, all the chips that are being made. They use lots of metals and things, but that's just come off the ball. So it's neither here nor there. And for some of Australia's commodity prices, things like iron ore, they have come off a bit. They've come off $10-20 a tonne. So just in the neutral. Stock market's strong. Not that you'd hike interest rates because of the stock market, but it's giving a wealth effect again, a little bit like the house price series. And current interest rates, they're restrictive. I'm moving that to the edge of we should, other things being equal, be thinking about a rate cut, but we're not yet because of that one and possibly, which is the inflation rate and probably
which tokens do you need to move and which direction you need to move them to get a rate cut?
This
and
one,
how far do you want to move it?
Has to move to there, which probably means we need another quarter or two of 0.6, 0.7 inflation rate. Because when you look at the mathematics of a 0.6 or 0.7, so 0.6 times 4 to get an annual rate is 2.5%. 0.7 times 4 is 2.8. So if we start getting 0.6s and 0.7s on your inflation rate, the RBA is going to say, oh, look, we've got a 2-point-something annual inflation rate. Just by the way, one other thing, Mark, which is a sleight of hand, that electricity subsidy rebate that the Treasurer announced in the budget, and it's happening in Queensland too, I believe.
No, by a much greater amount.
By even a big amount. So some states are doing it.
It's a grant in Queensland. It's $1,000.
$1,000. And the rental assistance mechanically feed into the inflation numbers. Yep. So they take effect on the 1st of July.
But they're fictional from my point of view.
But they will lower headline inflation.
Yep, they will.
I said it's a sort of
fictional.
P and thimble trick.
I don't like it, but anyway.
But the measured consumer price index for the September
takes
quarter
that into account.
Will probably be almost zero. And that's why the Reserve Bank is saying, hey, we've got to look at trimmed mean, we've got to look at underlying inflation, because that's a little bit like when bananas went up because of the cyclone.
Or lettuce.
And lettuce went to $10 because of the floods in Lismore.
So
this is the one that has to move. Inflation. I think the labour market's almost there. So we're going to be getting worse unemployment numbers.
So we don't need to move any of the other tokens. You think?
Not really.
Yeah. If they consider neutral with GDP in the easing column.
Yep.
You feel sort of fairly confident